You've heard it 1,000 times. Diversify your portfolio. But here's what most people miss. If all your diversification is just a bunch of US companies, you're not really diversified. You're just overexposed to one market. Most investors stop at US stocks, and while the US is strong, it's only 60% of the global market. That means you're missing nearly half the world's opportunities and potential returns. So what's the smarter move? Picking foreign stocks one by one? Too complicated. The real answer is finding the right international ETF. One fund, dozens of countries, thousands of companies. But not all ETFs are built to last. Some are cheap and boring, some are exciting and risky. Only a few truly deliver over the long haul. In this video, I'll show you and Josh the top 5 international ETFs. I'll be comparing them side by side based on total returns, dividend income, fees, risk, everything that actually matters if you're planning to hold for the long haul. And I'll show you the one international ETF I'd choose if I could pick only one for the next 30 years. And at the end, I'll show you how putting just $7 a day into that one ETF could grow into over $650,000 and pay you more than 60 grand a year in dividends. Before we dive into the individual ETFs, let's take a step back and talk about why international ETFs matter in the first place. For many investors, the bulk of their portfolio is focused on US companies, and that makes sense. The US has some of the biggest, most innovative businesses in the world. But here's the truth. US markets make up only about 60% of the global stock market. That means you're ignoring international stocks. You're missing nearly half of the opportunities available worldwide. International ETFs give you an easy way to fill that gap. Instead of trying to buy dozens of individual foreign stocks, an international ETF lets you own shares of thousands of companies across Europe, Asia, and emerging markets, all in a single trade. You get instant diversification, exposure to different currencies, and access to industries that might be underrepresented in the US market. Another key benefit is balance. When US markets struggle, international stocks often perform differently. That diversification can help smooth out the ride of your overall portfolio. And on top of that, many international companies are strong dividend payers, meaning you don't just get growth, you also get consistent income potential. The problem is, not all international ETFs are created equal. Some spread themselves too thin, while others are overly concentrated. Some keep costs low, while others eat into your returns with high fees. And while many promise growth and income, only a few have delivered over long time periods. That's why the real challenge, and what we're about to figure out, is finding the one ETF that checks all the boxes for growth, dividends, costs, and risk. Now that we've set the stage, let's get clear on how I'm actually comparing these ETFs. Because if the goal is to pick just one fund that's worth holding for decades, the standards can't be low. That bar has to be set pretty high. The first factor I'll look at is performance. It's not enough to check how an ETF did last year. I'll review 1-year, 5-year, and 10-year results to see how each fund has performed through different market conditions. Consistency is just as important as big returns in a single year. Next is dividends. Many international companies pay attractive dividends, and ETFs give us access to that income. But I'm not just looking for a high yield today. I want funds that actually grow their payouts year after year. That's what helps build a dependable income stream over time. Then there are the holdings. What companies are inside the fund? How are they spread across countries and sectors? A good fund should balance concentration with diversification. Too much exposure to one region or sector can add unnecessary risk. Risk is another big piece. Volatility, standard deviation, and turnover all give clues about how stable or unpredictable the fund might be. Then there are expenses. A fund's expense ratio might seem small, but over decades it can take a big bite out of returns. The cheaper the better, as long as quality doesn't suffer. Finally, scale and efficiency matter. Larger ETFs with billions under management typically offer better liquidity and tighter tracking of their benchmarks. Put all that together, and we've got a clear checklist. With these criteria, it'll be easy to see which ETFs are good and which ones fall short. So let's start working through the lineup, beginning with number 5. SPDR Portfolio Developed World ex-US ETF, commonly referred to by its ticker symbol SPDW. This fund is designed to give investors broad exposure to developed markets outside the United States, which means you're getting access to companies across Europe, Asia, and other developed economies. Over the last year, SPDW returned about 12.7%. Over 5 years, it's up roughly 40%. and over the past decade, about 64%. Nothing explosive here, but remember, this is a fund built on stability, not fireworks. Add in its ultra-low expense ratio of just 0.03%, and you've got one of the cheapest ways to invest internationally. Dividends are another important part of this fund. SPDW pays a dividend yield of about 2.7%. Its dividend growth over the past decade has averaged around 4.3% per year, with a stronger bump recently. So while the payouts won't knock your socks off, they've been steady, and that steadiness matters for long-term investors. Now, let's look at the holdings. This fund holds more than 2,300 companies. The top names include giants like ASML, Samsung, Nestle, Toyota, and HSBC, but no single company dominates. In fact, the top 10 make up less than 9% of the whole fund. That wide spread lowers the risk of one stock dragging down your entire investment. In terms of risk metrics, this ETF has a standard deviation of about 11.4, which is relatively low, and an annual volatility of around 16.52%. It's not a particularly risky ETF. With all of this, you have one of the cheapest international ETFs available. So what boxes does SPDW tick? Low cost, huge diversification, stability, and a respectable dividend yield. And what boxes does it miss? Dividend growth is on the slower side. Long-term appreciation lags behind other options, and overall, it's more steady than exciting. That makes SPDW a great fit if you want a safe, set-it-and-forget-it core holding. But if you could only choose one international ETF for the long haul, its slower growth keeps it from being the top choice. In a couple of minutes, I'll show you the one international ETF I'd choose if I could only pick one for the next 30 years. And at the end, I'll show you how putting just $7 a day into that one ETF could grow into over $650,000 and pay you more than 60 grand a year in dividends. That's 10 times more than the number 5 pick. The fourth ETF on our list is the iShares Core MSCI Emerging Markets ETF, with a ticker symbol IEMG. Unlike SPDW, which focuses only on developed markets, IEMG takes you into the world of emerging markets, countries like China, India, Brazil, and South Korea. This makes it an appealing choice for investors looking for faster growth and exposure to economies that are still developing. On performance, the story is mixed. Over the last year, IEMG returned about 14.3%, which looks strong, but stretch out the timeline and things get weaker. Over 5 years, it's only up about 16%, and over 10 years, roughly 60%. That's behind what we've seen in developed markets. Costs, on the other hand, are very low, at 0.09%, and with more than $100 billion in assets under management, it's highly liquid and easy to trade. The big issue here is volatility. Emerging markets tend to soar during good times, but can struggle badly in downturns. On the dividend side, IEMG has a yield of about 3%, the highest so far. It also has a 10-year dividend growth rate of about 5.6%, with a massive growth spike of about 26% in the most recent year. That shows there is dividend potential here, though it comes with ups and downs. On paper, IEMG looks extremely diversified. It holds nearly 3,000 companies, which sounds like a massive spread, but here's the catch. A lot of that weight actually sits in just a handful of giants. We're talking about Taiwan Semiconductor, Tencent, Alibaba, Samsung, and HDFC Bank. Those 5, along with a few others, make up about 24% of the entire fund. So while the number of holdings looks impressive, the reality is that a small group of companies drives a big chunk of the results. The fund is tilted heavily toward technology and financials, which can drive growth but also increase risk. In terms of risk metrics, IEMG has a standard deviation of 10.92, with a volatility around 18.11%, making it more volatile than SPDW. That risk is tied to political and currency issues in emerging markets, as well as the heavy concentration in a few large companies. So how does IEMG stack up? It checks the boxes for low cost, high dividend yield, and access to fast-growing economies, but it misses on consistency, long-term performance, and stability. That makes IEMG a powerful complement to a portfolio, but if you could only pick one international ETF, the volatility makes it too risky to stand alone. And that brings us to number 3. WisdomTree International Hedged Quality Dividend Growth ETF, with a ticker symbol IHDG. This ETF takes a slightly different approach than the ones we've covered so far. Its focus is on high-quality companies that consistently grow dividends, and as the name suggests, it's also currency hedged. That hedging means US investors don't have to worry as much about the ups and downs of foreign currencies cutting into their returns. Now, performance. Over the last year, IHDG actually slipped about 2.6%, which isn't great. But step back and the longer-term picture looks stronger. Over 5 years, it's up about 25.5%, and over 10 years, more than 81%. Expenses are also on the high side at 0.58%, which is significantly higher than the low-cost index funds we've looked at. Dividends are central to this fund. The current yield is about 2.6%, which is decent, but what really stands out is the growth rate. Over the last 10 years, dividends have grown at nearly 8.8% annually, and in the most recent year, dividend growth exploded by more than 61.66%. That makes IHDG a strong candidate for investors who prioritize income growth. In terms of holdings, this fund is much more focused. It owns about 268 companies compared to thousands in SPDW or IEMG. The top names include BP, SAP, GlaxoSmithKline, UBS, Nintendo, and ASML. The top 10 holdings account for about a third of the fund, which means it's definitely more concentrated. Sector exposure leans toward industrials, technology, and consumer cyclicals, so you get a mix of defensive and growth-oriented companies. Risk levels are fairly moderate. The standard deviation is around 11.2, and the volatility is about 16.8%. Turnover, though, is high at about 52%, which means the fund is more actively managed, swapping out positions much more often than something else, and this explains the higher fee associated with this fund. So, how does IHDG do when we run it through the checklist? It ticks the boxes for strong long-term returns, excellent dividend growth, and the extra stability of currency hedging, but it misses on short-term performance, low fees, and diversification. That makes IHDG a solid choice if your top priority is income growth, but if you could only pick one international ETF for the long haul, the higher expenses and inconsistency hold it back. Now let's move to number 2, a fund that takes a completely different angle. Invesco S&P International Developed Momentum ETF, with a ticker symbol IDMO. As the name suggests, this fund takes a momentum-based approach, focusing on international companies that are showing strong recent price performance. The idea is simple. Stocks that are trending higher often continue to do well, and IDMO tries to capture that upside. Looking at performance, IDMO has some of the most impressive numbers of all the ETFs we've looked at so far. Over the last year, it returned about 24%, which is very strong. Over 5 years, the fund is up about 73%, and over 10 years, it's gained roughly 111%. Expenses are middle of the road at 0.25%. That puts it at the very top of the pack in terms of long-term appreciation. On the dividend side, though, IDMO is not nearly as impressive. The current yield is only about 1.9%, the lowest of the group, and dividend growth has been modest. While the 10-year dividend growth rate is about 11.8%, the actual cash flow from dividends is relatively small compared to other funds. That makes IDMO more of a growth play than an income generator. Holdings tell the same story. IDMO owns about 200 companies, making it more selective than broad funds like SPDW or IEMG. The top 10 holdings make up about 26% of the portfolio, with names like SAP, Royal Bank of Canada, HSBC, Deutsche Telekom, Spotify, Rolls-Royce, and Alliance. The fund is especially concentrated in financials, which make up 47% of the fund, followed by industrials at about 17.5%. That heavy sector concentration can boost returns, but also adds risk. And speaking of risk, this is one of the bumpier rides. Standard deviation comes in at about 12.2, and annual volatility is almost 19%. On top of that, turnover is extremely high at 115%, which means the fund is constantly shifting its holdings to chase momentum. So what boxes does IDMO tick? Strong long-term growth, solid sector leaders, and reasonable expenses. And what boxes does it miss? Dividend yield is weak, volatility is high, and it relies too heavily on financials. That makes IDMO exciting if you're chasing pure growth, but if you're looking for one single ETF to anchor your portfolio for decades, the lack of balance keeps it from being the best choice. Now let's move to number 1, the fund that actually strikes that balance between growth, dividends, cost, and stability. and in a couple of minutes, I'll show you and Josh exactly how this top pick can build more than twice the wealth of SPDW and generate 10 times more dividend income. And my top pick is the Schwab Fundamental International Equity ETF with the ticker symbol FNDF. This fund uses a fundamental weighting strategy rather than traditional market cap weighting. In other words, instead of just buying more of the largest companies, this ETF selects and weights its holdings based on factors like sales, cash flow, and dividends. That approach helps tilt the portfolio toward companies with stronger financials rather than just the biggest names. As for its past performance, over the past year, FNDF returned about 13.9%. Over 5 years, it's gained around 66%. And over the past decade, it's up nearly 75%. Expenses are very reasonable at 0.25%. That puts it ahead of funds like SPDW and IEMG, and while it doesn't quite match IDMO's explosive growth, it balances growth with much more stability. Dividends are another big win here. FNDF pays a yield of about 2.9%, and more importantly, those payouts have grown at an impressive 10% annual rate over the last decade. On diversification, FNDF strikes a healthy balance. It holds about 945 companies, with the top 10, names like Shell, Samsung, Toyota, BP, Roche, and HSBC, making up only about 12% of the fund. That means no single company has outsized influence, and sector exposure is well spread across financials, industrials, consumer staples, and tech. Risk metrics confirm its balanced approach. FNDF has a standard deviation of about 11.72, with volatility around 16.49%, both of which are moderate. Turnover is very low at just 12%, which makes it a true buy and hold style ETF. So let's run it through the checklist. It ticks the boxes for solid long-term performance, strong dividend yield and growth, broad diversification, reasonable costs, and moderate risk. And what does it miss? Honestly, not much. It doesn't deliver the absolute highest returns like IDMO, but it makes up for it with consistency and balance. That's why FNDF stands out as the single best choice. It may not grab headlines, but if you're looking for an ETF you can buy, hold, and count on for the next 10, 20, or 30 years, this is the one. And now that we've crowned FNDF as the winner, let's take it one step further and see what kind of wealth and income it could actually build over time. Let's keep it simple. Let's say Josh puts $7 a day into FNDF, about the cost of a coffee. And from there, we let three powerful forces go to work: a dividend yield of 2.92%, an average dividend growth rate of 10.04%, and a share price that's historically grown about 5.3% per year. Based on these metrics, by the end of the first year, Josh would have invested about $2,555. With that daily $7 contribution, after 10 years the investment would be worth around $39,000. By year 20, the balance would grow to about $156,000, with annual dividends reaching nearly $10,000. And by year 30, compounding really shows its strength. The balance climbs to roughly $653,000, and annual dividends rise to about $62,000, the equivalent of more than $5,000 per month in passive income. Now that you know my best pick, you might be wondering, how does it actually stack up when you put it side by side with the other ETFs? Let's line them all up, starting with the weakest performer and working our way to the top. At the bottom, we've got SPDW. After 30 years, it ends with about $253,000. Safe, steady, conservative, but its modest dividend growth keeps the long-term balance lower than the rest. Just above that is IEMG, finishing near $296,000. Its exposure to fast-growing emerging markets gives it more upside than SPDW, but the volatility and concentration risks chip away at its compounding power. In the middle sits IHDG, landing around $450,000. Dividend growth is its strength, but higher fees and some recent underperformance keep it from breaking into the top tier. Next is IDMO, climbing to roughly $591,000. Momentum stocks give strong appreciation, but the high volatility and constant turnover make it less predictable as a long-term hold. And finally, at the very top is FNDF, compounding to about $653,000 over 30 years. It leads the pack in total balance. SPDW comes in last with about $6,000 per year after 3 decades. IEMG does a little better at around $12,000 per year. It's an improvement, but still not enough to really stand out for income-focused investors. IHDG raises the bar, hitting about $24,000 annually. Then we get to IDMO with roughly $35,000 per year. But once again, FNDF is in a league of its own, producing around $62,000 per year. That's 10 times what SPDW delivers and nearly double IDMO's payout, making it the most powerful compounding income machine of the group. Want to know how to turn a one-time $500 investment into a portfolio that pays over $5,000 in monthly dividend income? Click the video on screen to find out.